Welcome to Mayer Brown's Global Financial Markets Podcast. Each 30-minute episode is designed to help listeners better understand the legal issues that impact their business given the ongoing uncertainties in the financial markets worldwide. Speakers from across Mayer Brown's practices and offices provide their timely insights on a wide range of topics, including finance, financial services, and insurance regulatory developments, securitizations, and litigation in the United States, the United Kingdom, Europe, and Asia. We hope you enjoy the program.
Hello, listeners. Our topic today is FTC and CFPB priorities for the auto industry. We'll discuss all things FTC and CFPB, including the FTC's proposed auto rule, enforcement trends against auto dealers and financing companies, and both agencies' focus on fair lending. My name is Tori Shinohara, and I'm your host. I'm a partner in Mayer Brown's Washington, D.C. office, and I'm a member of the Consumer Financial Services Group. I represent clients in connection with federal and state enforcement matters, and I also counsel clients on compliance with federal and state consumer financial laws and regulations. My guest today is my colleague and my partner, Chris Leach, who is a litigation partner in Mayer Brown's Washington, D.C. office and a former enforcement attorney with the FTC. Chris represents and advises clients in a broad range of industries, including the fintech, financial services, automotive, and telecommunications industries, and also defends those companies in litigation, before government agencies, and in self-regulatory proceedings. Chris, thanks for joining us today.
My pleasure, Tori.
So, Chris, if we're thinking about the auto industry and your former employer, the FTC, the most obvious starting point is the auto rule that the agency released earlier this summer. Can you tell us a little bit about that effort?
Thanks, Tori, and that's really a great place to start. The biggest auto news from the FTC is obviously the proposed auto rule that was released in June. This rule has been 10 years in the making. Goes all the way back to 2010's Dodd-Frank law, which gave the FTC authority to engage in rulemaking under the Administrative Procedure Act regarding auto dealers. And this is authority that very conspicuously was not given to the CFPB in that statute, making that the FTC is the only game in town on that front. So now this move, giving the FTC rulemaking authority under the APA, exempts the FTC from following some of the additionally cumbersome rules that apply to FTC rulemaking under Section 18 of the FTC Act, which known in the industry as Mag-Moss rulemaking. So now, before we get into the rule, I'll just tell you why is the agency doing this? Why are they going through the rigmarole of doing rulemaking when they are primarily an enforcement-first organization? The main reason is money relief. Now, last year, the Supreme Court took away the FTC's most common avenue for monetary authority for violations of Section 5 of the FTC Act, which is their main authority for unfair and deceptive acts and practices. But that ruling, that Supreme Court ruling, did not affect the agency's ability to obtain money in connection with violations of FTC rules, which this auto rule would satisfy as part of. So now on to the proposed rule itself. The rule imposes a number of requirements on auto dealers specifically, and if you look at the release, many of these requirements come straight out of enforcement proceedings and things that they have previously sued dealerships in connection with. And so there are three buckets of provisions. The first bucket prohibits a set of specific misrepresentations that are taken, again, directly from prior enforcement actions, and they go from very broad to more specific, and you can take a look at those if you're interested. Now, the second bucket, the rule imposes new disclosure requirements for representations regarding add-on products, which are products or services added at the dealership level to an auto transaction, and also to representations regarding leasing or financing terms. And the third and final bucket, and this is the rules that it's most noteworthy from my perspective, are additional substantive rules regarding the sales of add-on products. Now, the law here requires a number of steps, but I think the thing I want to focus on here is their requirement of express informed consent to charge for add-on products. On its face, that's a very normal requirement. Obviously, every company needs express informed consent to charge for any product. But if you look at the definitions of express informed consent, the proposed rule says that a signed or initialed form or a form with pre-checked boxes is not sufficient for express informed consent, which means that some of the most common ways that companies document express informed consent wouldn't satisfy under the rule. We'll see if the agency clarifies what actually would constitute express informed consent in that context, but we'll have to see. The comment period on the proposed rule closed in mid-September and received a substantial amount of attention, more than 10,000 commenters, including a number of industry groups from both inside the auto dealer space and outside, including some groups from the securitization industry, just indicating how big an impact this rule could have outside of the auto dealer space.
Thanks, Chris. That's a great overview, very helpful for our listeners. Switching gears a little bit, when I think about the FTC and the auto industry, the other issue that always comes up is fair lending, which I know is a big deal for the CFPB, but can you tell us a little bit about the FTC's enforcement in that area?
Thanks, Tori, and I totally agree. Fair lending, whether it's in the auto space or beyond, is a hot topic in and of itself. You and I were just participating in an event on that topic last month for a hack day. But I'll briefly go over the FTC's enforcement program in this area and then talk about its two most recent matters, just to give our listeners a sense of how this plays out in practice. Now, in terms of statutory authority, we're still looking at our common players, the Equal Credit Opportunity Act, ECOA, and Section 5 of the FTC Act, which again is the FTC's authority against unfair and deceptive acts and practices. Now, Tori, many of your listeners are familiar with ECOA, but briefly, the key requirement there is an anti-discrimination provision, which prohibits discrimination against protected classes in connection with the provision of credit. And it's that last point in the provision of credit that is the hook for ECOA in the auto space, because nearly all autos, or a large proportion of them, end up receiving some sort of financing. And so aspects of the sale of the automobile will often then be viewed as being involved in the provision of credit, because those costs are financed by the consumer. So briefly, let's talk about how the agency actually approaches enforcement actions in this space. For fair lending cases, absent evidence of intentional discrimination, I'm thinking here of very bad emails, things of that sort, the agency often relies on a disparate impact analysis in their fair lending cases. And obviously, because in auto lending, there is often not a checkbox to indicate demographic information, such as racial characteristics, in connection with auto lending, the agency will use proxies for race in its analysis, which is often the BISG analysis. Now, if folks are not in the auto dealer space and are still listening to me, and they're wondering why any of this matters to them, I'll say that ECO analysis will end up involving your clients, especially if you're in the financing space, because when the FTC starts looking into fair lending issues, they will often send third-party subpoenas to all the indirect lenders that affiliate with the dealership in question, so that they can assess what the actual credit terms were for every customer during the relevant time period. Another thing to note for our listeners is that fair lending analysis might not be the reason an investigation opens. Many times investigations open not for the fair lending analysis, but rather because the agency believes that there are other law violations occurring, either UDEP provisions, or if the auto rule is finalized, things like the auto rule. And that's what gets the agency in the door. But during the course of an investigation, fair lending concerns can often arise. The way to think about it is the old adage of where there's smoke, there's fire. And for the FTC, that often if they believe that they're finding law violations, there might also be fair lending issues lurking beneath. So for indirect lenders involved in financing, I think those companies should be interested in compliance on even these non-lending issues, because it's those non-lending issues that could invite the additional scrutiny that might drag your company into an investigation through these third-party subpoenas. So just with all of that background in place, I just want to highlight the two most recent cases, and I'll just be brief. So the two most recent enforcement actions, one against a company called Bronx Honda in 2020 and Napleton in 2022, provide pretty good vignettes for the enforcement program. The Bronx Honda matter on the UDAP side was a pretty standard false advertising case, and on the fair lending side showed both a disparate impact analysis of higher markups for Hispanic and Black consumers, and also evidence of disparate treatment in the form of emails and documents indicating some sort of animus towards those consumers. In terms of the remedy the FTC obtained, there was a monetary penalty of $1.5 million. And in terms of conduct or relief, the key issue here is that the FTC imposed a fair lending program designed to limit flexibility in the charging of discretionary markups, since it was the discretion in imposing markups differently among different consumers that it seemed was the reason for the disparate impact between white consumers and Hispanic and Black consumers. One last thing to note about the Bronx Honda matter is on the policy matter, Commissioner Rohit Chopra, when he was at the FTC, he agreed with the case, but in a concurrence articulated his view that racial discrimination also should be pled as an unfair practice prohibited by Section 5 of the FTC Act. This is something I'm going to talk about again in just a second, and it's something that many of you are familiar with in connection with the CFPB's new rules regarding unfairness that they're going to be looking at in examinations. Now that the last case, the Napleton case, and again, I just want to flag, this is a case I worked on while I was at the agency. The primary focus of that settlement were add-on products. The dealers there were alleged to be deceptively saying that the optional add-on products were mandatory, or slipping them into customer agreements without further authorization. On the fair lending side, the issues involved not only add-on products, but also interest rate markups, that both those products were being provided to protected classes on a basis that disparately impacted Black customers more than non-Hispanic white customers. And to my knowledge, this is the first case alleging fair lending issues in connection with add-on products, although Tori might tell me if I'm wrong later in this show. And again, I'll note an important concurrence, and this time by Chair Lena Khan and Commissioner Slaughter, who wrote that discrimination should be pled as an unfair practice under Section 5 of the FTC Act. But again, that was only for two commissioners. That case came out at a time when there was a 2-2 Democrat-Republican tie in the commission, so that didn't reflect the view of the full commission. There is now a third Democratic commissioner, Alvaro Bedoya, but he has not, to my knowledge, expressed a view on this topic. So we'll have to stay tuned to see if the commission actually adopts that view as its policy in future matters. Now, Tori, I just talked about some trends we're seeing out of the FTC, but I know you do a lot of work before the CFPB and assume there is some overlap between the topics I just covered and what the Bureau is concerned about. So, for example, what are you seeing out of the Bureau in terms of concerns related to add-on products?
Yeah, that's right, Chris. I think there is a lot of overlap with respect to add-on or ancillary products. It continues to be a significant focus of regulatory scrutiny, not just at the FTC, but as you alluded to, also at the CFPB. And you talked a little bit about some regulation and enforcement coming out of the FTC related to the sale of add-on products in connection with auto financing. On the CFPB side, what we're seeing is that the CFPB is making allegations related to the servicing of auto loans that include these types of ancillary products. So specifically, during exams, for example, the CFPB has found that servicers engage in unfair practices by failing to request refunds from third-party administrators related to, quote, unearned fees from GAP products. and also by failing to apply the applicable refunds to the accounts after repossession or cancellation of the contracts. So in this particular scenario that the CFPB identified, although servicers maintained policies to obtain the applicable refunds, the CFPB alleged that they frequently failed to apply for the refunds from the third-party administrators. And then the servicers later sent deficiency notices to consumers and also reported balances to third-party debt buyers that included these allegedly inaccurate amounts in the deficiency balances that were owed by consumers. And so the CFPB essentially alleged that including these amounts in the deficiency balances resulted in substantial injury to consumers because the amounts to be collected were higher than the true amount owed. And then the CFPB alleged that the deficiency balances were likely to be collected by third-party debt buyers, even though the products provided no benefit because the vehicles had been repossessed and the accounts were charged off. And so according to the CFPB, consumers couldn't reasonably avoid this injury because they had no control over the servicer's refund processing actions. And also generally, they couldn't apply for such refunds for them by themselves because they were unaware that the contract provided they could do so. And the CFPB alleged as the kind of the final prong of unfairness that this injury was not outweighed by any sort of countervailing benefit to consumers or to competition. And then again, in this particular scenario, in response to these findings, the CFPB required servicers to remediate impacted consumers and implement additional controls to ensure that the servicers process add-on product refunds after repossession.
Thanks for that, Tori. You mentioned repossession, and speaking of unfair practices in connection with servicing, I saw the Bureau published a bulletin related to repossessions earlier this year. Can you tell us just a little bit about what the bulletin said and why it's significant, why we should care?
Yeah, that's right, Chris. So back in February of this year, the CFPB published Bulletin 22-04, which was called Mitigating Harm from Repossessions of Automobiles. And in that bulletin, the CFPB expressed concern that the high prices for used cars at that time might create incentives for, quote, risky repossession practices. So just taking a step back, it's not surprising that the CFPB has been very focused on issues related to consumers who have defaulted on their loans and subsequently have their cars repossessed. The Bureau, which is a consumer protection agency first and foremost, is focused on making sure that servicers get it right on repossessions because this should be and is the last resort for servicers when consumers are unable to pay on their obligation. But the CFPB is concerned about unfair and deceptive acts or practices that occur in connection with repossession because consumers obviously are harmed by having their car repossessed. Not having access to a car, for example, inhibits a consumer's ability to get to work or to get to school. And so the repossession bulletin that the CFPB put out reminds servicers of the types of unfair and deceptive acts or practices that the Bureau has identified through exams and investigations in the recent past, and also warns servicers and loan holders about the risk of enforcement if the CFPB identifies similar unfair and deceptive acts or practices. And so just to kind of walk through a couple of examples from the bulletin, I won't go through everything in great detail because it's rather long, but just for example, the first type of unfair practice that the Bureau has found related to repossession practices that's articulated in the bulletin has to do with when borrowers have taken certain steps to avoid repossession, but then the servicer repossesses the car anyway. And here are a few examples. So the Bureau has alleged in certain cases that it's an unfair practice when a servicer repossesses a car, even though the borrower made and kept a promise to pay that ultimately brought the account current. Another unfair act or practice that the Bureau has identified is when a borrower made a payment to reduce the delinquency to fewer than 60 days past due, and under the servicer's own policies, that should prevent repossession, but then the car was subsequently repossessed nonetheless. The third example of an unfair act or practice is when a borrower made a promise to pay and that date to pay had not yet passed, but the servicer repossessed the car anyway. The Bureau has said that's an unfair practice. And then the fourth example is when a borrower has agreed to extend the loan term in order to avoid repossession, but the borrower's car is repossessed even after agreeing to that extension. So I think the bottom line here is that the Bureau is expecting servicers to be communicating timely with its repossession agents, and also to have processes in place to make sure that if a consumer takes an action that under the servicer's own policies and procedures should prevent repossession, that it actually has the effect of canceling the repossession or avoiding referral for repossession in the first place. So related to repossession, but after the repossession actually takes place, the CFPB has also made a couple of other allegations. One example is when a servicer charges for personal property fees to consumers in circumstances to go ahead and retrieve their personal property from a repossessed car. That's one example of an unfair practice that the CFPB highlighted in its repossession bulletin. And another example of an unfair practice that happens after repossession or can happen after repossession that the Bureau highlighted is when the servicer charges forced place insurance premiums after the car has been repossessed and is no longer in the consumer's possession. So again, another practice that the Bureau believes could be unfair. So that's a little bit about what the repossession bulletin says. It really reminds servicers about acts or practices that the Bureau believes could be UDAPs in connection with repossession. But I think what's really notable about the bulletin is that it states, quote, "The Bureau intends to hold loan holders and servicers accountable for UDAPs related to the repossession of consumers' vehicles," end quote. So in other words, if you're a loan holder or if you're a loan servicer, the Bureau is essentially putting you on notice that it may take the position that you're responsible for the repossession practices of a third party that you've hired either to service the loan or to complete the repossession.
Thanks, Tori. That's really interesting, and that's really helpful context. But I want to switch gears just a little bit. I talked earlier about the FTC's focus on fair lending. I know you do a lot of work in this area, fair lending and responsible lending. Can you tell us just a little bit about what's going on in that space at the Bureau in terms of fair lending?
Sure, I'd be happy to. So as you're well aware, but our listeners may not be following these issues as closely, racial equity continues to be a major focus for federal regulators, particularly the CFPB. And the Bureau seems to have, fortunately for some, kind of moved away from this focus on dealer markup in the context of indirect auto lending, but seems to still be very focused on issues of fair lending, for example, pricing and underwriting in connection with direct auto lending. Also, the Bureau more recently has been focused on lenders' lending practices and whether or not they could be exclusionary in a way that could violate ECOA. So the Bureau has asked about and looked at where lenders are lending geographically or where they're not lending, the types of consumers that lenders are not doing business with, for example, from an immigration perspective, what types of income lenders do not accept, for example, certain types of public assistance income. So, I think it's fair to say that fair lending is still a major focus at the Bureau in connection with auto lending and servicing. And I think to that point, it's also worth noting that fair lending issues are not limited to lending, despite the nomenclature, but also extend to servicing. And the CFPB earlier this year released an advisory opinion that reiterates the Bureau's position that ECOA extends beyond applicants seeking credit to include those that have received credit. And so the Bureau's position is that ECOA's anti-discrimination provisions and adverse action notice procedural requirements extend to servicing and collections. And so I think what's notable about this is that often servicers take advantage of adverse action notice provisions that do not require an adverse action notice for borrowers who are in default on a credit obligation. But there may be circumstances where borrowers are coming to you as a servicer and asking for workout options when they're in imminent default and are not yet in default on the obligation. And so depending on the facts and circumstances there, this could potentially trigger adverse action notice obligation. So that's just one thing to kind of keep in mind. Another thing under the umbrella of fair lending that the Bureau has been very focused on, and this isn't specific to auto, but digital redlining has been an issue that Director Chopra has talked a lot about publicly. He clearly has concerns about how digital marketing may be used in a way that filters or excludes people or communities of color. And this is another emerging area of risk from a fair lending perspective. And I think it's something to really keep in mind if you're engaged in digital marketing.
Now, Tori, are there any other areas that the CFPB appears to be focused on in connection with auto lending and servicing as we wrap up?
Yes, there's a number of other areas that we've seen both on the supervisory and on the enforcement side, but since we're running out of time, I'll just mention one other area of focus, and that's credit reporting. So there was a lot of confusion in the industry about how to report COVID-related relief properly in light of the CARES Act and what Congress was hoping to accomplish through the CARES Act back in 2020. And you may recall that servicers were really inundated with requests for forbearance. And then at the same time, also trying to quickly figure out how to report any sort of COVID related repayment plans or relief and to report them correctly. Now, fast forward to 2022 and going into 2023, this credit reporting from the early 2020 time period during COVID is going to be in scope for exam periods. And I think there's bound to be some issues that are identified by examiners. So I think the big question is really how lenient the CFPB is going to be in taking into consideration the enormous pressure that the industry was under during the initial wave of COVID to help borrowers, but also is in the midst of shifting to a remote work environment and also dealing with all of the other fallout from the pandemic and lockdowns. And so I think it's going to be a situation where the Bureau may be willing to take some of those factors into consideration, but I suspect that there will be some issues related to credit reporting coming out of that period. Also, I'd be remiss if I didn't at least mention this development that we talked a little bit about earlier, which has gotten a ton of buzz, which is the CFPB's change to its UDAP exam manual. Earlier this year, which signaled that the Bureau is going to be examining supervised entities to evaluate whether there's discrimination that could meet the statutory test for unfairness. And one of the areas that was specifically called out for examination under this new discrimination is unfairness framework is credit reporting. So I think for several reasons, credit reporting is going to be another big focus over the next few months and years for the Bureau. So as you can see, there's a lot going on right now in the auto space. But before we go, given your unique perspective, Chris, in coming from the FTC, is there anything else that our listeners should be thinking about right now?
Yeah, Tori, I think just briefly, I think there are two issues of general applicability that folks in the auto industry should always keep aware of. So first is the privacy rulemaking term, the commercial surveillance rulemaking, which I'm sure you and most of the listeners are aware of. It's very broadly addressed at this commercial surveillance term. It's an ominous term that the agency has defined as basically any commercial use of consumer data. There's no proposed rule yet, just a call for comments due in the middle of this month. But if they end up writing a proposed rule that is as broad as it seems, I think there's going to be a lot of room for unintended consequences across the economy, including the automotive industry. And then second, I just want our listeners not to forget about the FTC's overarching UDAP authority, not only for dealers, but also for OEMs and for anyone else making consumer representations, either themselves or via third parties, because the FTC, when all else fails, can always investigate and sue people for making misrepresentations about their products or services.
That's great. Thanks, Chris, so much for being here today on this podcast. And more importantly, thank you to our audience for listening. If you have any questions about today's podcast or anything else related to global financial markets, please email us at gfm@mayorbrown.com. Thanks for listening.
We hope you enjoyed this program. You can subscribe on all major podcasting platforms. To learn about other Mayor Brown audio programming, visit mayorbrown.com/podcasts. Thanks for listening.